Hello.
Hey, how you doing, Angela?
Not bad. How are you?
Well, you sure you're not doing bad? We're doing a remote today. Um,
Coming to you from my home today. I managed to break the bone where my toe meets my foot.
ouch.
So, trying to stay off it as much as possible. The doctor said, "Oh, just stay off of it for 6 to 8 weeks."
Oh
Like,
yeah, that's so easy. I got little kids running around, of course.
sure, no problem.
Yeah.
If anyone has a rascal I can borrow for trick or treating, that would be great.
Have you figured out what's wrong with it yet?
Yeah, it's a fracture in the bone, like where it meets where the toe meets the foot. I just basically severed my like toe from the
Oh my
foot.
gosh.
Anyway, but I'll be fine. I just need to stay off of it as much as
Yeah.
possible.
Okay.
So,
Well, in other news, we did a really fun Rossmore presentation this week to how many? About 100 people, right?
about 100 for it's the Rossmore Financial Forum. If you were there and if you're now joining us, welcome to the show. It was
We
really
welcome
fun
you.
to be with everybody, to be back in person doing things. It's just the energy is different and it's really phenomenal.
Really, it really was great. They had great questions, great attention.
Yeah.
I thought it was wonderful. I felt really welcome, didn't you?
Oh yeah,
Yeah, it
absolutely.
was great.
Thanks,
It was
Rossmore.
great. So, welcome to a place of possibility. I'm Richard Del Monte. We're happy to have you here.
I'm Angela Wright. Great to be here.
So, what are we talking about today,
All
Dave?
right. Today we are teeing up the changes taking effect next year to all of the government rules that affect our daily lives. And we're going to discuss some year-end planning opportunities that you can use before New Year's Eve to reduce your tax burden.
Yep. So, let's get started. And there are some huge increases in these categories this year because of inflation.
Inflation.
Ta-da! So first off, IRA and Roth IRA contributions are increasing by $500 each next year, from $6,500 to $6,000 to $6,500, and the inflation adjustment built into IRA contributions has been a huge benefit to savers over the years. Because back when I started in the business, when
When
dinosaurs
dinosaurs
ruled
ruled
the
the
earth, yes, right. The annual limit was $2,000, and it seemed like a bunch of money then. It was a large amount of money, but not now. But if you're over age 50 next year, your catch-up provision will let you put in another $7,500.
That's awesome.
A total of $7,500. Sorry. So then the maximum employee contribution that will be able to be made to 401k and 403b plans will increase by $2,000, from $20,500 this year to $22,500 next year. And if you're over age 50, you'll be able to go from a maximum of $27,000 to $30,000. So, it's all, this is inflation adjusted stuff. It's all good. It's all good.
Absolutely. And if you're listening to this, we'll put all of the numbers that we're throwing at you in the show notes, and you can go
Yep.
to the description
Right.
and find a handy dandy chart for all of this.
Right.
Another limit that's going up is the income limit for Roth IRA contributions. If you're single, you can contribute up until $153,000 in adjusted gross income. Married couples now top out at $228,000. Got to do some special planning if you're over those income limits.
And there's little phase outs when you get up to the top. So you got to be careful about that too. They make you cut back how much you can put in.
Yeah. And incidentally, Congress appears to be poised before year end to pass what's known as Secure 2.0, a law that will allow retirement savers between 62 and 64 to contribute up to $10,000 in 401k and 403b catch-up contributions. But beginning next year, these contributions will no longer be tax deductible. They'd be after tax Roth, technically, contributions. So, the Congress doesn't want to give up all the tax revenue, but they want you to be saving more.
Yeah, for
Go
sure.
figure. But on the bright side, you don't get taxed when you pull this money and all of its growth out after 59 and a half because they're Roth contributions. So still really, really great. It'll also allow taxpayers, Secure 2.0, to defer taking required minimum distributions from their retirement accounts beyond age 72, where it is today, all the way out to age 75 by 2030, which is
Ooh.
super smart. Yeah, this is great because we're living longer.
You can tell we're financial advisors. We think this stuff is great, right? It's just
We're
interesting.
okay, when all these like tax changes came out here in the office, we have one guy who's like on the news. The minute something breaks, he
Oh,
sends it
yeah.
all out in an instant message to us, and everybody stops, and it's like, "Oh, what's going on?"
Yeah.
We're all aflutter. It's pretty funny, but
He loves to broadcast the news. We're going to give him his own broadcast network, I think. Yeah.
But this is really great stuff. And, it's smart of the government to do this because we're living longer than ever before. And they have a vested interest in assuring that our money will last for a longer period of time. We've got 80-year-olds taking like 10% of their IRAs out every year. That's not sustainable.
Yep. And it's rare that we all say we agree with something Congress is doing, right?
Right.
Very rare.
This is one of those
but
rare
we do.
times.
We agree with that. Yeah.
Yeah.
Okay. So also on the topic of RMDs, if you have an inherited IRA, so let's say somebody died and left you an IRA, I want you to listen up because there's been some big changes for this year. First of all, I'm going to separate the conversation from people who died before 2020 and then people that died after 2020. So if you had an IRA before 2020, you've been using an RMD table, required minimum distribution table that was based on the IRS table they published. Well, in 2022, that table has been changed. So it reflects longer life expectancy. So to be able to calculate the right RMDs, you can't just look at the table and see where you are in 2022. Oh no, that would be too simple and too easy. Too logical. What you have to do is go back to the date of death of your family member or whoever died. And so if let's say it was 2015, you have to go back and look and think about how old you were in the year after the person died. So if the person died in 2015, how old were you in 2016? Then you look up that age on the new IRS 22 inherited IRA table, RMD table, and then you look. That's going to give you a number like 25.3 years or whatever it is. Then you have to calculate how many years have elapsed since that time. So from 2016 to 2022, it's been 6 years. So you're going to subtract 6 years from whatever years are on that table. Are you confused yet? And then that's the RMD for this year. And then every year after this, you subtract a year from that. If you don't get that right, it's the penalty. Angela, what's the penalty for that?
50% of what you were supposed to take out each year. Plus, then you got to pay the tax on that.
50 every year. So if you forget for 3 years, the penalty is only 150%. What's the big deal? Okay. So now if you go back to the age 2020, so if someone died in 2020 or later, there's a whole new regime that you have to live with. And basically you have to take the money out over a period of 10 years. And there wasn't any guidance from the IRS before. So a lot of people were just assuming, well, I just won't take anything out and I'll defer it until 10 years after the person died. Well, now the IRS just recently in the last month belatedly came out with the recommendations and the rules on how that's going to be applied. So if your decedent, the person who you inherited the money from, was under the age where they had to take required minimum distributions when they died, then you don't have to take any distributions until 10 years after the person died. You can just pretend that it's not there. That goes even if you're like 80 years old and you inherited money, and you normally have to take RMDs on your own accounts, not on these inherited IRAs. You got 10 years before you have to take anything out. But if your decedent died after they were already taking required minimum distributions or RMDs, then you have to apply the 2022 table and take that amount out every single year until the 10 years are up from the date of death. So the IRS knows that you weren't able to do it in 2021 because it's already gone on this new regulation that they just did. And interestingly, they're not going to, penalize you retroactively for something you didn't know you had to do. So they've actually waived that requirement for 2021 and 2022, but it'll start next year. So you've got to start taking RMDs next year based on your life expectancy in 2020 or whenever the person died. And go that way and subtract a year each year. I mean, is that plain as mud or what?
Piece of cake.
It's complicated, right? I mean, it's super complicated.
Yeah.
But that's how the IRS works, folks. That's why people like us have jobs, actually.
I mean,
Because
it's true. I can't imagine, your average person out there, especially somebody who's grieving now, like finding these tables, doing the math. I mean, I
yeah,
know we're smart people, but come
right,
on, IRS. You
right.
gotta be kidding me.
The good news is they don't make you take money out until the year after the person died. But the person
It's gonna
that
take
died,
you a
if they
year
were,
to do the calculation.
yeah, I mean, and if the person died, you have to take a distribution for the year that they died, right? So, yeah, it's a mess. It's just clearly a mess for sure.
Gosh.
All right, so moving on. For those of you who are self-employed and maintain your own retirement plans, the maximum contribution for a defined contribution plan, which would be things like 401ks, SEP IRAs, profit sharing plans, KEOs, things like that.
Who's using a Keo out there? In my 20 years in this business, I think I've maybe come across one Keo. If you're using one, call me because I want to know.
Yeah, that's true.
Anyway.
That's true. You should. There's probably if you still have a Keo, there's probably better opportunities for you in something more modern. But the limit has gone from around 60,000 to 66,000 per year, and then if you have a defined benefit plan, the maximum you can put away is $265,000 in 2023. That is a lot of money. Angela, we need to do a future podcast on this because, people don't know that if you're an older business owner, you could sock away hundreds of thousands of dollars tax deductible from a retirement plan, so we probably got to do that. Don't you think?
Yeah, let's do it.
Okay. All right.
Okay, switching away from retirement contributions and plans and required minimum distributions, we're going to start talking about Medicare and Social Security. So this is for my friends who are 65 and up. Start paying attention now. And if you are about to turn 65, also pay attention. You've got a couple of months to get yourself signed up. Medicare premiums are going down.
Say what?
I know.
Did I hear that right? Wait.
I never thought I would utter. It's not by much, okay? It's $5 for those who are on the lowest premium plan. So about
I can buy a thimbleful of gasoline with that. That's good.
You can get almost a gallon. Almost.
Once a month, I can get a thimble. Okay.
And so if you're on the higher tier of Medicare premiums, it's about $18 less, so $560 a month.
Very generous of them. And that's per person. $560 a month per person if you're in the high income bracket.
Yeah. So this is good and frankly kind of unexpected news. A couple of other great things going on with Medicare right now. The cost of your insulin co-pays are going to be capped at $35. There is no deductible for Part D or Part B covered insulin. Recommended vaccines covered by Medicare Part D and Medicaid will be totally free.
Well, that's good.
And then, yeah, right. And then in 2025, big changes are coming. This is like huge. Yep. Out-of-pocket drug costs are going to be capped at $2,000.
Wow. That's pretty good because, older folks are always using those experimental drugs and, sometimes they're $50,000 a month. Mm-hmm. And if you're going to be capped at $2,000, that's just a sweet deal.
This is really, really great news. In a sea of terrible news out there. This was really heartening to read. And so also our last episode was all about Medicare. Open enrollment is happening right now and it's available until December 15th. So if you're not signed up or, you're just turning 65 or about to, go get that taken care of. If you're already on Medicare, this is the time to review your drug plan. So if you have that A, B, and D combo, get on, research the drugs you have, and make sure you're still on the best plan. You'd be surprised how often this changes, even if you didn't change drugs.
Yep.
Okay. So, and I know somebody who I got to drive this point home, who did this year and is saving $1,000 between him.
Oh, yeah. Yeah. That's actually me. Yeah, I signed up for a different drug plan and I switched, and it's $1,000 a year in tax savings in drug plan savings. Yeah, you really have to do this. You have to look every single year. It's a pain. You got to enter in all your drugs and everything into the website, but it's worth it because you will be surprised how much you can save. And also you can put in the different pharmacies you go to, and you might find that the difference between going to CVS or Walgreens or your local pharmacy or Costco is even in there. I mean, they're dramatic. So don't be dumb and miss out on these opportunities just to save money.
Yeah.
Especially when eggs are $7 a dozen.
Oh my gosh, that's just ridiculous to me.
Yeah.
You know, I found this cereal that my kids like. It looks like Fruit Loops, but it's called Magic Spoon, and it's got no sugar and it's loaded with protein. So it's like they're eating a little, like protein shake, but it looks like Fruit Loops, and they just think it's the best thing ever. Like that, I'm giving them a total treat on a Tuesday morning. So I wasn't paying attention that day that I grabbed it off the shelf and threw it in the cart. Well, I go to make an online order. That cereal is $9.99 a
What?
$9 for 4 servings in that.
Oh my gosh.
Oh, the cost of groceries is just absurd.
And you see the other way they do it though is like the ice cream, it used to be a half gallon, then it was 1.75, and then next thing you know, it's gonna be the same price, but you're only getting a pint,
Right.
And that's how they do it that way too. They just same, it's not going up, we're keeping the same prices, but you just get half as much.
Oh, it's so ridiculous.
Yeah.
Well, and here's some more, not so great news. Social Security taxes are going up. They're going to cover more wages. So in 2022, this year, you've paid Social Security tax on 147,000 of earnings, but next year you'll pay it on 160,200. Once you've hit that point in your earnings for the year, the Social Security drops off. So if you've been out there wondering, like, why is my paycheck a little bit more, maybe the last portion of the year, it's the Social Security tax disappearing.
Yeah.
So this is an increase of like $800 in tax that you're going to pay next year if you're in those income brackets, which is not great. But this is one of the necessary changes to keep Social Security going. So I have to say, as much as I don't want to pay that tax, I'm happy to see them starting to implement some of the things that are necessary to keep our Social Security on track.
Yeah. Yeah.
And on that front, if you're collecting Social Security, you're getting an 8.7% increase in your monthly check starting in June.
Yep.
It sounds like a lot.
Yep. And incidentally, on the top, I'm sorry, did I?
No, go ahead.
Good. So incidentally, on the topic of Social Security, if you're approaching the age where you're trying to decide whether you should take it at 62, 66, 70, whatever, and you really don't know, don't listen to your brother-in-law who's a plumber. Call us, for our clients. We run analyses, really sophisticated analyses for you to tell you when you should take that. When's the ideal time where you'll actually maximize your the value of your estate, how much money you have to leave your kids, and how much money you can get during your lifetime. So don't leave it to chance. We talk to people and they go, "Oh, I made this decision." I'm like, "Oh, come on, you got to be kidding me." We could, if you just talked to me about it, we could have made a gigantic difference in your standard of living. So don't make the mistake and think you can do it by yourself. Are you doing heart surgery by yourself? Probably not. So don't do this either. It's equally important. I mean, it's not life-saving, but when you if you're turned 90 years old and now you're suddenly find yourself that you have to be going to work at Walmart, you might think twice about it. It's really, really important to get this right. Mm-hmm. So, okay. Unless you think that 8.7% increase that Social Security is giving you is some kind of a raise, as we said, you've looked at the cost of gasoline, eggs, milk, everything has gone way up in value. They've skyrocketed, and all Social Security is doing is keeping you even. It's not really a raise. Yeah. All right. Let's move on to your income tax for next year. The standard deduction for individuals is moving from $12,950 to $13,850 for single filing taxpayers, and for joint filing taxpayers, it's going from $25,900 to $27,700. So let's talk about some opportunities to save taxes this year with our end of the year look. First of all, if you make charitable contributions and you're over 70 and a half, you actually can do something called a qualified charitable distribution. That allows you to take money out of your retirement account, IRA, 401k, whatever, and send it to the charity, and it's not going to be taxable to you. Not a taxable distribution like they normally are. Why would you do that as opposed to just writing them a check? Well, as we just talked about, the standard deductions are really high. For a single person, $13,850, and for a married couple, $27,700 next year. So if you don't have enough itemized deductions to go above that, which many people don't, then you're not going to get any tax benefit out of a charitable contribution. But if you're required to take distributions from your as RMDs from your IRA, then this could reduce the amount that's taxable. So now you're going to get a benefit. So it's a huge benefit for many, many people. They don't know about it. They don't know they haven't done the numbers and see if it makes sense, but this is a big one that you should really consider. Make the distribution from your charity, from your IRA, but you have to be over 70 and a half to be able to do that. Okay. It's a workaround to the loss of the tax deduction. Next, if you're going to have higher Medicare premiums next year, because you had high income in 2021, you may be able to reduce your premiums next year by letting the Social Security Administration know that you've had what is called a life-changing event and that your income will actually be lower next year. So, Angela, what's a life-changing event?
Oh, so that's includes marriage, divorce, death of a spouse, work stoppage or reduction, aka retirement, sale of an income-producing property, loss of a pension income. So if you've been paying a higher Medicare premium and you've had a change in your income, the form to file as soon as possible is called an SSA-44. And really, this is a gold mine for people who are qualified because they think people often are like, well, I retired this year, so I'm not going to have any income. But 2 years ago was my highest earning year ever. And so I'm still paying this higher premium. No, you don't have to put up with that. File the form and get your premiums reduced right away.
So as an example, if you had a rental property a couple of years ago, or in 2021, and you sold it and you made a bunch of money on it, well, guess what? You no longer have the property. So now you can qualify for one of the exceptions, even though you made a bunch of money, a boatload of money. So I mean, you really need to talk to your accountant and or your financial advisor, and see if you can qualify for one of these, because, like Angela said, you could save $10,000 a year.
Yeah.
I mean, in Medicare premiums next year and the year after. So it's worth it.
Yeah. Yep. A few other, little planning tools that we always take a look at towards the end of the year are standbys, are, deferring income to 2023. If you think your tax rate will go down next year, let's say you're retiring at year end and you always get a really big bonus. Maybe that bonus could come to you in January of 2023 when you don't have any income. You won't get taxed as much on it this year. Or, if you think your tax rate is going to go up next year, take a little bit more income, sell that property, sell that stock if you have any with a gain right now, and, take care of it this year. And similarly, when you're making deductible state income or property tax payments or even business expense payments, consider which year you're going to get the highest deduction and then act accordingly.
Definitely. Yeah.
Don't forget that the SALT deduction, your state and local tax limitation that was put on us recently at $10,000, expires in 2025. Hallelujah. So those are going to come back in a huge way unless Congress acts to change that. Hopefully they don't, because this was a big hit for a lot of people, and getting those deductions back will be really meaningful.
Yeah, it's created gigantic tax increases for people over the years and a lot of heartburn for people in blue states, right? It's been terrible.
Yeah.
Okay. And if you're looking for a last minute tax deduction, a big one, consider using a donor advised fund. So what does this do? Well, it allows you to make a charitable contribution into an account that you open up at a place like Fidelity, Schwab, Vanguard, I don't know who else, maybe any of the big brokerage houses. And you open up an account and you make a contribution to it. And that contribution itself gives you a big tax deduction. So for example, if you make, systematic contributions to your church or, to the American Cancer Society or whatever your favorite charity is every year, you could take like 5 years worth of those contributions and advance them and deduct them this year. You don't have to give the contributions to the actual charities until future years, because the deduction is based on when you put the money into the donor advised fund at the brokerage house. And then the money can grow tax free over time. And then you can make distributions to your charities. You can have, we use Schwab for that. And we just have give $2,000 of these guys, $3,000 of these guys, and they just send the checks out and they go out to people. But you got the deduction in the year when you had the highest amount of income. And that's really valuable. And as a little added bonus, you can contribute appreciated securities. So those are things you bought a long time ago. They made a bunch of money. Like say you got Apple stock, you paid $13 a share for it. Now it's worth whatever. and you made a whole bunch of money, you can give them shares of Apple and get the tax deduction based on the fair market value of Apple right now, not what you paid for it way back when. So the donor advised funds are fabulous if you are charitably inclined. If not, you're going to feel like you're just giving money away and you probably don't want to do it.
Yeah.
So
Good
there we
point.
go.
This is a great way, if you're really into sticking it to the IRS and you do charitable contributions, or maybe you're giving money to your kids, donating appreciated stock is such a great way to do that, because you get, the full credit, or sometimes even a tax deduction for the donation. And then when the charity, or let's say a child in a younger tax, or an adult child at a younger, lower tax bracket sells it, the IRS doesn't get any tax revenue from it, right? When a charity sells a stock, that they don't pay a tax on that. So if you're about sticking it to the IRS, it's a great place.
For sure. We have people that, that tithe, pay tithing. They pay 10% of their income to the church. So every 5 years, they just take, big 5 years worth of that, put it in a donor advised fund and divvy it out over the years. And that way they're getting the deduction, right, in that 1 year. Yeah. So it's great.
And that plan works really well for people who have more of a cyclical business or get large bonuses. You have the actual income there to stock
for sure. Yeah, definitely.
So.
Okay.
That's a wrap on our year-end tax updates for you. Lots of pretty good things coming in 2023 as far as I'm concerned from a tax perspective. And 2025, things change really significantly for us.
For sure.
Thank you so much for tuning in and listening. If you have a question or a topic idea, please feel free to send us a message. We would love to hear from you. If you are interested in learning more about the way that we invest client assets, we are giving away copies of The Investment Answer. It's a wonderful book. You could probably read in an afternoon, very short and to the point. But if you want to be a more educated investor, it's a great read. If you'd like to schedule a time to talk to us, you can book a meeting through Calendly. That's in the show notes or on our website. And please just reach out to us. If there's anything that we can do for you, we'd be happy to help.
Yep. And the investment answer is an ebook, so we can just email it to you, which is great. Yeah. So thank you very much for being with us on this episode of A Place of Possibility. We appreciate your attendance and watching us. And remember, until next time, remember, you're invested and so are we. Take care. Bye-bye.
Bye, everyone.